Well, this was a delight to read this paper. It was a wonderful paper, very thought-provoking, and I have a lot of things to say about this. I have only 15 minutes, so I will just skim through a few things. But at the outset, I should say, actually, when Avner and Jim asked me to discuss this paper, I'm not Jewish, unlike Jonathan Burke, but his question came to my mind: why me? Right? So I must say I'm glad that they gave it to me. But you know, I have three possible reasons for the, or possible explanations that I could see. One is that it's probably the last time I'm allowed to do this. It's an insider joke. The second one is that they they needed to find somebody who could at least pronounce the names of the two first authors of the paper, and maybe also the last one. And then the third one is they were looking for a 51-year-old. And a finance professor who must have thought about these things, right? And indeed, you know, I've thought about this, and so actually this was very helpful in thinking about annuities, life insurance, health insurance, and so. And there are a few things that I think that have forgotten about. If you're a 51-year-old, there are certain things that you do think about that is not in the paper. But I'll come back to that later. So this is a rich paper on optimal investment in retirement annuities, life insurance, and health insurance. It has a normative part. It has a descriptive part. I like really the computation of welfare cost of actual choices. They use homothetic utility, so they can actually translate it into wealth. How much more wealth should you give the 51-year-old in order to move to the to have the same utility as optimal consumption? And these numbers are staggering, not 40%. Thought-provoking. Question is, why was this not done earlier? You know, I'm 51 years old. I would have wanted them to do that 10 years ago. At least. I'm 52, but when I was asked to discuss the paper, I was 51. So a related study was done. I'll actually show you that later on income, labor income insurance. So the results, I think Ralph explained this very, very well. So they computed various deltas, income flow differentials from insurance contracts across health and mortality statuses. They compute optimal deltas for several age cohorts, and I'll focus on the lifetime optimal ones. They assume lock utility with calibrated bequest motive, etc. They compare everything to observed deltas, and they compute the welfare cost. And one would need to increase the 40% in wealth of the 51-year-old agent in order to reach the optimum. And mostly because of suboptimal mortality delta. That's where all the action is. The health delta seems to be fine. And then they determine how to implement optimal deltas with a mix of annuities, life, and health insurance policies. But I think I'm not going to say much about this. The results are very intuitive. I shouldn't go through this because actually he explained it very, very well about why you want to have a negative health delta, for instance, because margin utility is reduced if you're ill, and because saving decreases since death occurs earlier, right? So that's where, of course, heterogeneity comes in, because if you're married and you have kids, you may want to think about this twice. So you die earlier, but your wife and your kids don't, right? So I'll just skip this. This is a table, the table version of one of the figures that he showed, where he showed optimal deltas for a 51-year-old as a function of age in the future. All right, so the big thing is that the mortality deltas are way off. The health delta is basically on target. And this is the picture from their paper, right? So if you look at a 51-year-old, he should have an optimal mortality delta of $60,000, which means moving from good health, if now, I think I'm in good health, right? If I drop now dead here, right, I should get from these life insurance contracts $60,000, right? Or I would get this. The optimal one is $188,000, right? So I went back to my computations at home to see whether actually I'm rather here than there. And I must say, I'm closer to this one, so I'm very happy. Why is the mortality delta suboptimal? Ralph mentioned a few possibilities. incomplete markets. It's hard to see this, especially because for mortality, for the life insurance and annuity products, it seems to be, that market seems to be working, fairly well. I think very much when I look actually at prices of life insurance, the group life insurance contracts that actually I'm confronted with, they seem to be relatively fairly priced. Right? Unlike, for instance, in my case, earthquake insurance, it's really pretty badly priced. Right? Stupidity, well, that would contrast with evidence in applied economics on optimal decisions on job search, labor market participation, family planning. It turned there's a long literature out there that actually people actually are pretty sensible about this. So I'm going to assume here, for the sake of the argument, that the observed choices must not be explained using the stupidity argument. And besides, why would people get the health delta right if they can't get the mortality delta right? The health delta, if anything, is harder to get right. Again, I'm talking about of personal experience. Right? So cheap shots at the paper, some weak assumptions. In the interest of my colleagues in behavioral finance, I just say, use of power utility. Nobody does that anymore. You use prospect theory or something like that. I wouldn't go that way, by the way. It's just a criticism. There are only 3 health and mortality states. This may actually be important, right? But the first time you do this, I think, with 3 states it would be fine. But I think the more important one is there is no provision for investment to go back to a better state. That is, if I'm move from good to poor health, if I go too much to conferences and I gain weight and I become obese and a diabetic, I actually will invest into increasing the probability of moving back, right? And certainly decreasing the probability of dying, right? And there is no provision for this here, and I think this is a very important part of people's investments as well and their decisions. But again, that's about health, and that seems to be optimal. What about taxes? Jester, where are you? Right, that's what you would have asked, right? And actually, I do think about these things a lot, right? And taxes are ignored. Why is that important? Because precisely for the mortality part of it, the mortality delta, you have plenty of products out there that would implement a non-zero mortality delta with all kinds of tax advantages and disadvantages, deferred taxation, optional capital gain loss realization taxes, and estate taxes, right? Now, I don't know to what extent this explains what's going on, but at least it could potentially explain why the deltas, the health deltas are optimal, whereas the mortality deltas are not, right? Now, let's go to the health costs and the health delta, because I don't think that some of the numbers that they get from a pretty reliable source are actually quite correct or maybe misinterpreted. So to give you an example for about health insurance cost, this is their panel of how much a 51-year-old on average spends as out-of-pocket health expenses. So it's the mean is 0. So if you average 2 and 0, that gives 0. I guess so. So they hardly spend anything. These are the out-of-pocket expenses. What are these? These are all the contributions you have to give to your insurance beyond the ones that your employer gives, plus all the co-pays, and if you don't have any insurance, everything, etc. Right? AARP has published these studies of the actual expenses at about the same, expressed for the same year, 2005. And as you can see, these numbers here are much higher. See, there are total health spending for premiums and services for all is 3,829, right? And this is actually the age cohort to 64. The premium themselves are already fairly high, and especially the ones that have private insurance. They don't have a private employer insurance, right? The uninsured spend less than these privately insured people. So there's a question about this. There are actually some other interesting numbers. Like, for instance, I won't explain this in detail, but for instance, 2/3 of families with private insurance only, so employer-sponsored insurance, fully two-thirds of these families spend more than 10% of their income to health. Right? That's easy to verify. Actually, these people hopefully, get a tax deduction on their income. Right? So to give you another example, this is Caltech's rates for health insurance. This is beyond what Caltech pays. Caltech doesn't pay. They're very greedy. They don't pay very much. So if you go with an HMO like Kaiser, and you have a family, you pay $241 per month, so it's $2,800, $600 per year. If you really want to go high flying, it's $1,057 per month. That's a staggering $12,000 a year, right? I know those people who do that, right? So these are costs for this year, 2012. Right? That raises another issue. The numbers are averaged in the paper. People must have predicted when they became 51-year-olds in this cohort, which is already way back because this is a cohort that starts in 1936. They must have predicted the health costs are going to actually increase a lot more than factually happened, and maybe we should take that into account. Whereas with life insurance and so, the costs have not increased that much. Here are some ideas about some numbers about private insurance, how much it costs, and you can see these numbers. An average premium for family coverage in the age 50 so for me would be $6,751, and I can tell you don't get much insurance for that, right? Another thing, there's a lot to be said about this. Employment status determines the cost very much, and I'll say something more about employment status later. The coverage rates that they have in the paper look very good. So the only thing I did is basically some sanity checks because I looked at these numbers and this is really, really low, right? So the cost seems not, there may be some issues with the cost. The coverage rates are correct. And if you look at the number of people uninsured in their tables, you compare it to what AARP has collected, it seems to be right on target. Now, how would misestimation of health-related costs affect the result? Let me briefly walk you through the reasoning. Right? How can you get the right result, how could you get this this result that the deltas, the actual deltas, look optimal, even if you didn't use the right data, the right cost? So in that case, what happens is that some money that they count as income does not go to consumption, but to paying health insurance, right? So the utility in good health state is actually lower than the estimate, and the optimal health delta is going to be higher. Effectively, what basically is going to happen, people want to insure more, right? Because the margin utilities are lower for same consumption in a good health state. Everything has to do with the fact that you want to equalize margin utilities in all these possible states, all right? So it would mean that the optimal deltas should be higher than what the authors compute, right? So then you would say that actually the result should be in the data that the optimal deltas is below the actual deltas, but they don't have that. So the observed deltas, however, start from an overestimated consumption in the good health state, and hence are underestimated. Right? And if the out-of-pocket expenses are underestimated as well, consumption is overestimated in mediocre health state as well, and hence you basically close the gap. Right? So you get this seemingly okay result that people understand everything about and can do things right with health insurance, but in fact, accidentally, by underestimating the cost and the expenses for health insurance, they basically got that result. Right? Something to think about. Mortality deltas, actually the same argument applies to the mortality deltas, right? But the payouts are easier to track, so it's actually much easier to figure out what happens there. So it looks as if the agents are overinsured, but they wanted to, right? So the observed mortality deltas are too high. So they actually take too much life insurance as relative to annuities, right? Except for younger people, 51-year-olds, for whom costs are really on the mark, right? So speaking out of own experience, as I mentioned, it looks like these costs of annuities and life insurances that they actually are imputing seem to be very much for what I see when I actually have to decide every year what to do. Unexplained. There's unexplained cross-sectional variability in the observed deltas. So let me go back to the fact that actually in a lot of these contracts, your employment status really determines the cost, and that is very, very important. Even moving from one university to another, right? We know that has a huge effect. I gave you the numbers for Caltech, what it costs to have Blue Cross Blue Shield, right? For a family, it's $12,000 per year. You move to the University of Utah, that drops to $200 per month, right? Something like that, right? So that's a huge, right? It's a huge difference, right? Are there left out risks? Income volatility. So I thought a lot about, what would that have here? There's a literature out there that started with John Heaton, Debbie Lucas, Davis Willett, so smoothing labor income fluctuation, because we know that, especially for highly educated people, labor income is a very systematic risk, right? When you but you don't get tenure, this is it. You have to go flip hamburgers at McDonald's, right? Or you work for Wall Street. Right? So, but it turns out, I will give them the slides. You can go through the arguments, whether the markets are incomplete or complete. When the markets are complete, that doesn't matter. When they're incomplete, there may be some issue there, but it's not really that big. So there's adverse selection in the insurance market. Actually, there's a little detail that they worry a lot about fairness of prices. It turns out not to matter very much when there is adverse selection. So the conclusion is it's a very important subject. The extensive literature on insuring labor income risks. There is still a puzzling result of these optimal health deltas where you have suboptimal mortality deltas. Maybe that has to do with the data, right? Or should we conclude that people are stupid? I really don't want to do that because I know the organ that is responsible for all these decisions, and it's incredibly complicated and beautiful, and it does very good things. All right. Thank you for letting me go 30 seconds over time.
Questions?